Hey guys, I'm scared. The stock market's down. There's a recession coming. My portfolio is on fire. Look at that. My money is literally on fire. What should I do? Should I sell it all? Should I put all my money in the couch? Hell no. Okay, so in today's video, I'm going to tell you exactly what to do and what's going on. So let's get started. By the way, Shamow says to like and subscribe. So yeah, what's going on now is the market is panicking. The S&P 500 is tanking. The Nasdaq is in correction. Everything is going haywire. Why? Let's get into that really quickly. The market is currently marking fear, nearly extreme fear. And you know what? Dow closes down 600 points. Nasdaq enters correction after weak jobs report. So yeah, there was a jobs report just last Friday, and it was pretty bad. It was pretty bad. And particularly painful was in the information space, tech stocks. These are the high-paying stocks, the people that make the money, the people that spend the money. And they're the ones that are losing their jobs. And when they lose their jobs, everybody loses their jobs. It's a downward spiral effect. You don't want those people losing their jobs because it goes everywhere. They spend money like crazy. They buy houses. They keep the economy afloat, and everything else is pretty bad too. Manufacturing stands still. Business services are down. The only thing up is education, health, construction, and some leisurely things in the government. But really, it's a really bad jobs report. And also, the unemployment rate just jumped 0.2% to 4.3%. Now, this is significant because of... Well, I'll discuss that in 1 second. But here's the history of the unemployment rate. Look at it. It tanked, and now it's spiking again. The unemployment rate is going up. Why? Well, we'll discuss why, but it's actually an indicator. There's this thing called the SAM rule. If you haven't heard of it, it's actually not too complicated, but it is a predictor of recessions. And you'll notice that it actually usually happens during a recession. Now, this is a pretty reliable indicator. It's predicted every recession since 1955. Every recession. So basically how it works is, obviously it's named after a person, Claudia Sam, S-A-H-M. And what it does is it basically means that it takes the average unemployment rate over the past 3 months, the average unemployment rate, and it's risen by 0.5 percentage points from its most recent low. That's basically what that means. It's pretty simple. Now, there's this other factor, which you have probably heard of. You may not have heard of the SAM rule, but you've definitely heard of this, the inverted yield. So this is the other predictor of a recession. Now, the inverted yield is a little bit different from the SAM rule. This one actually does just a simple yield conversion check. Usually, it's the 2-year versus the 10-year. Normally, the 10-year is supposed to be higher than the 2-year, but it's inverted, so yeah, it's not good. It's not good. So yeah, an inverted yield curve occurs when yields on short-term bonds rise above the yields on longer-term bonds. So what that means is investors in bonds sense trouble in the water. They're scared. And when they're scared, they're pulling the money out of the short-term bonds and shoving them into the long-term bonds. So the yields invert. And when the yields invert, it's a sign of fear among the investors. And honestly, when the investors are scared, that's a pretty healthy sign. It's a good sign of a recession. As you can see here, it's predicted every recession since 1970. Every recession has been preceded by this yield, an inverted yield curve. It's when it goes below this red line. The red line is 0. When it goes below the red line, it's an inverted yield curve. And just after that, shortly after that, between 6 and like 12 or 20 months, after that, recession. Every time. It's predicted the 2020 recession, the 2008 recession, everything. 1980, all of those recessions, holy cow. Those are bad. So yeah, things are not looking good. The market volatility spiked the last couple of days due to these reports. Everybody is freaking out. The stock market itself is tumbling. The S&P is down. As I mentioned, the Nasdaq has already corrected. And you know what? It may go down more. Now, are we going to go into a recession from here? Maybe, maybe not. I can't predict these things to a certainty, but it's possible. Now, whether or not we go into recession, this is what I do, and this is what I recommend others to do as well. There is a particular rule in here, and that is don't panic. The worst thing you can do when everybody else is panicking is to panic. Panic selling is literally the worst thing you could ever do. As Warren Buffett says, the great Warren Buffett, be fearful when others are greedy. Be greedy when others are fearful. So I'll give an example of myself. In 2020, the pandemic, the world was ending, right? Everybody thought the world was going to end in March 2020. Stocks tanked, I think, like 30%. Everybody was panic selling. I wasn't. I loaded the boat on the strongest name stocks that I knew at the time. And then what happened? While everybody else put their money in the cushions, I gained 530% in that 1 year alone. In 1 year, 2020, I gained 530% in my main portfolio. Now, again, I'm not going to be able to repeat that. That was an extraordinary year. I will never be able to repeat that year, but I'm just trying to say that the best idea to do in these situations is be greedy when others are fearful. Now, here's the current situation. Let's look at this graph. This is the S&P going back many, many years, from 1981 to current. Shows again how old I am, but anyway. So I've marked here a couple of recessions. We had a flash crash in 1987, a recession in 1990. Can you even see the stock market blip in that recession? It's barely even visible. Then you have the crash in the 2000s, the crash in 2008, and then the freakish nature that we had recently. But what has happened? What has been the arbiter? What have these crashes been? They've been great buying opportunities. Look at this. There has never been a 30-year span in which the market has been down over that 30-year span. Think long-term, not short-term. These are fantastic buying opportunities. Had you bought during the dot-com crash, you'd be up 5x today if you bought during the dot-com crash. And this is just the S&P. On certain stocks, you'd be up so much more. If you bought during the 2008 crash, again, you'd be up over 5x today. That's what these crashes are. They're great buying opportunities. If other people are panicking, and if they're selling these strong stocks, say Microsoft, Nvidia, Apple, where do you think those companies are going to be in 10 years? Think about that for a second. Look at those companies today and think 10 years out. Where are those companies going to be? Do you think they're going to be at zero? I don't think so. They're going to be much stronger in the future than they are today. And that's the main thing, is especially in these situations, is to focus your money in strong companies with excellent balance sheets. And that's the other thing, is during these recessions, the Fed will likely lower interest rates significantly. If the recession's bad enough, the interest rates may go back to zero. And if they go back to zero, that's going to supercharge the economy. And likewise, that would supercharge the stock market. So you'd end up with a situation like 2008. The stock market skyrocketed thereafter. And it ended up being a fantastic buying opportunity. So yeah, just look at Microsoft themselves. What actually has happened in the last 3 months? That's all that's happened is you've lost 3 months of gains recently. That's really it. In the long scheme of things, is losing 3 months of gains the end of the world? I think not. It is not the end of the world. So yeah, as I mentioned before, what you want to do here is focus on strong companies with a strong balance sheet. Because remember, if you're loaded in risky stocks, in small risky stocks that are losing money and have lots of debt, they're the most likely to go under in a recession. They are the most likely to actually hit zero in a recession. So yeah, focus on strong stocks with a strong balance sheet, big companies, strong companies, growing companies. And if you want to know what to buy, just take a look at my Patreon. Actually, I have valuation models on over 15 different companies. And you could know exactly what I think the intrinsic value is on those companies today. So yeah, that's what I think. Let me know what you think. Is this a buying opportunity or are you panicking? Don't forget to like and subscribe. Thank you for watching, and I will see you in the next one.